Welcome to the Opening Bell Report.
Today, we are looking at something that, well, it feels a bit like finding a monster hiding in plain sight. We usually talk about the brains of the AI revolution. You know, the names, NVIDIA, AMD, all the chip designers. But we, and pretty much everyone, have been ignoring the backbone.
The infrastructure. It's a classic case of the market getting distracted by the flashy object and missing the foundation.
Right.
But based on this analysis report we're covering today, dated February 7, 2026, the market has just had let's say, a very rude awakening.
A rude awakening, or, maybe a very profitable one if you were paying attention early. We're diving into a specific analysis on Supermicro Computer Inc., ticker SMCI.
SMCI.
And the headline of this report is what grabbed me immediately. It calls SMCI the sleeping giant.
And for good reason.
Yeah.
Though, to be fair, sleeping kind of implies they were inactive. This giant has been building muscle in the gym while everyone else was looking the other way.
Well, the giant isn't sleeping anymore. The report is titled, "The Sleeping Giant Wakes Up." And it drops a statistic right at the top that I actually had to read twice.
It's a staggering number.
It says SMCI has hit 123% year-over-year revenue growth.
123%.
It sounds statistically impossible. I mean, we're talking about a hardware company here, a legacy company, as the report puts it. Hardware companies usually grow, maybe 10% in a great year?
If they're lucky, yeah.
123% sounds like a software startup, not a server maker.
And that is exactly why this report is so important. What we're seeing and what the analyst is arguing is that this isn't just a volatility spike. It's not a fluke.
It's something more fundamental.
It's a structural repricing. The market is finally waking up to the reality that SMCI isn't just a box mover anymore.
Okay, so let's unpack this, because box mover is exactly how I think a lot of people, myself included, perceive them.
Right.
They order a server, they put it in a box, they ship it. End of story.
Right. But that description is totally obsolete.
So what's changed?
Completely. The report argues that SMCI has evolved. They've become the primary infrastructure layer for the AI age. And because of that, well, the mission for our deep dive today is to figure out exactly how a legacy company manages to grow 10 times faster than its peers.
And whether that aggressive buy rating in this report actually holds water.
Exactly.
Aggressive buy. I like the sound of that, but when I see that next to a chart that's already moved so much, my skepticism radar just goes off.
As it should.
So let's start with that explosion. The report calls it Unpacking the Growth Anomaly. We established the headline number, plus 123% revenue growth.
Right. And in the world of growth stocks, that top-line expansion, that raw revenue number, that's the metric that matters most. It tells you if there's real demand.
But context is everything. How does that 123% compare to, say, the other guys? The report mentions Dell and HPE.
This is where the contrast becomes really stark.
Yeah.
The analysis points out that competitors like Dell and Hewlett-Packard Enterprise are seeing server revenue growth in the low double digits.
Low double digits, so what are we talking?
We're talking 10 to 15%.
10 to 15 versus 123.
Exactly.
That is insane. SMCI is growing literally 10 times faster than the competition. It's like Dell is driving a Honda Civic, which is a fine car, reliable, gets you there.
A perfectly good car.
But SMCI is strapped into a SpaceX rocket.
That is a very fair analogy, and the market reaction reflects that. On the day this report was released, February 7th, 2026, the stock jumped 11.44% to hit $34.38.
Which is a massive move for a single day. But let me push back a little. Is it possible this is just a short-term pop? Like maybe they just landed one lucky, huge contract.
It's a valid concern, but the report argues that's not what's happening. The expert insight here is that this kind of growth rate is incredibly rare in hardware history. It signals something fundamental has changed in the plumbing of the data center.
The plumbing.
The report states it very clearly. SMCI is capturing the entire initial wave of the AI infrastructure build-out. They aren't just getting a slice of the pie.
They're eating the whole first course.
That's it.
Yeah.
So the question then becomes, why?
Exactly. Why now? Why specifically in early 2026? What is the catalyst?
It comes down to physics.
Physics.
Thermodynamics, to be specific. The catalyst is the arrival of NVIDIA's new Blackwell chips and the H200s. These are the new brains of AI we talked about.
Right, the latest and greatest.
They're incredibly powerful, but they have a side effect. They run incredibly hot.
Ah, okay. So the chips are getting so powerful, they're essentially melting the old cooling systems.
In a word, yes. The report is very blunt about this. The quote is, "Air cooling fails. You simply cannot cool these new high-density AI clusters with traditional fans. It's just not possible.
You need something more advanced.
You need liquid cooling."
And I'm guessing liquid cooling isn't something you can just whip up over a weekend.
No, it's highly complex. And this is where SMCI's unique position comes in. According to this analysis, SMCI is the only vendor with the capacity to ship liquid-cooled racks at this volume immediately.
Immediately being the key word there.
Precisely. In the AI race, time is the most valuable currency. If you are Meta or XAI or some other cloud provider, you can't wait 6 months for Dell or HPE to retool their entire supply chain.
You need those chips running models today.
Right now. And because SMCI can deliver, they're winning the contracts.
So it's a first mover advantage in this very specific, very critical niche. But surely the other guys can catch up. I mean, Dell isn't a small company.
They can, eventually. But SMCI has what the report calls an engineering moat. A big part of that is their building block architecture.
Building block architecture, that sounds modular. Like Legos.
That's a perfect way to visualize it. Most competitors use rigid, traditional supply chains. They design a server, lock it in, and mass produce it. If a new chip comes out, it's a huge redesign process.
A whole new product cycle.
Yeah. But SMCI uses this modular design. They can swap out components, power supplies, cooling modules, motherboards, like you'd swap out a Lego brick.
So when NVIDIA drops a new chip, SMCI can just snap it into their existing architecture.
Exactly. And this lets them integrate that new tech and ship months faster than anyone else.
Months. In the tech world, that's an eternity.
It's the difference between winning the contract and losing it. And there's a culture factor here, too. The report drops a fascinating stat.
Oh, yeah?
50% of SMCI's employees are engineers.
Half their staff. That seems incredibly high for a manufacturing company.
It is, but it means they aren't just assemblers. They co-design with NVIDIA. They speak the same language. So in a race where being first to market matters more than a few percentage points on price, this makes them the logical choice for big tech.
Okay, so the tech is there, the speed is there, but let's play devil's advocate. Not everyone is sold on this. The report mentions a bear case from critics, and it's all about the margins.
Yes, the margin compression.
The report says margins have dropped to 6.3%. That is razor thin. If you're growing 123%, but you're only keeping 6 cents on the dollar, is that sustainable?
That is the big controversy. The critics see that 6.3% and they say, see, they're just buying revenue, slashing prices to move boxes. They see it as a sign of weakness.
But the report disagrees with that take.
Strongly. The analysis frames this not as a weakness, but as a deliberate strategy. They draw a parallel to Amazon.
The Amazon parallel. Okay, walk me through that.
Think back to early Amazon. For years, Wall Street hammered Jeff Bezos because Amazon made almost no profit. They poured every single cent back into growth.
Your margin is my opportunity.
That's the one. The report argues SMCI is doing the exact same thing. They are sacrificing short-term margins dropping to that 6.3% to execute a massive land grab. They want to own the customer.
So the idea is you get your servers into their data centers now, even if you don't make much money on the initial sale, because once you're in,
the install base is locked in. You're the incumbent. And that's when the high-margin services, the upgrades, the maintenance contracts, that's when they all follow.
They're playing the long game.
Correct. And that creates what the report calls a value trap versus growth trap arbitrage opportunity. Basically, the market is mispricing the stock because it's looking at the margins all wrong.
Okay, let's talk about that pricing, because the valuation numbers in this report are, they're a little weird.
They are very unusual for a company growing this fast, yeah.
The PE ratio is around 26x. That seems pretty reasonable.
Right.
But the price to sales ratio, the report says it's 0.83x.
Right.
Wait, let me just wrap my head around that. A price to sales of 0.83 means the market is valuing the entire company at less than its annual revenue.
Yes.
You're paying 83 cents to buy $1 of their sales. For a company that is doubling its revenue, that just doesn't compute.
That's the disconnect. High-growth tech stocks usually trade at 10x, 20x sales, sometimes more.
Right.
A 0.83x valuation is typically reserved for, dying retailers, companies that are shrinking. It is not a valuation you see for an AI infrastructure leader growing at 123%.
So the market is pricing SMCI like it's a bankrupt department store, but it's actually growing faster than almost anyone in the S&P 500.
That is the core of the strong buy thesis. You are getting hypergrowth, but you're paying a value price for it. It's a rare anomaly.
Okay, so the fundamentals are, according to this report, screaming buy. What about the technicals, the chart? The report has a section on the reversal signal.
It does. And for the traders out there, there are some very specific signals mentioned. The report highlights a bullish engulfing candle pattern.
Okay, break that down for the non-chart watchers.
A bullish engulfing pattern just means that after a period of selling, the buyers stepped in so aggressively on this one day, February 7th, that the price action completely engulfed the previous day's trading range.
So it's a strong signal of a reversal. A change in direction.
Exactly. And it happened right at a key support level. The stock had hit a double bottom around $27.60. It tried to go lower twice and failed both times. That creates a floor.
So $27.60 is the line in the sand.
Right. And importantly, this big move didn't happen in a vacuum. The report notes it came with above-average volume.
Which means?
Volume confirms the move. A price jump on low volume can be a fake-out, but high volume suggests institutional accumulation. The big money hedge funds, pension funds they're buying.
Smart money is loading the boat.
That's the interpretation, yes.
So where does it go from here according to the analysis? What are the targets?
Well, the immediate hurdle mentioned is breaking the downtrend line. But the report says if it holds above $32, the path of least resistance is higher.
And the target price?
The immediate technical target is a gap fill to $45. But the longer-term price target from the executive summary is $65.
$65. The stock is at $34.38 in this report. I mean, that's almost a double.
It implies about 90% upside over the next 12 to 18 months.
Wow. And just to be clear, even at $65, the valuation would still be pretty reasonable compared to other AI plays, right?
Exactly. It wouldn't be in nosebleed territory by any stretch.
So let's summarize this analysis report. We have the sleeping giant that has woken up with 123% growth, a strong buy rating, a price target of $65, and the final investment verdict is aggressive buy.
With specific entry and exit points, the report suggests entering under $35 and, crucially, setting a stop loss at $27.
That stop loss is important. That protects you if that $27 floor breaks.
Risk management is always key. But the risk-reward ratio here, according to the analysis, is just heavily skewed to the upside.
You know, what really sticks with me is the lesson here. It's so easy to get scared off by headlines. You see margins dropping and you immediately run away.
Right. It's a knee-jerk reaction.
But this deep dive really shows the importance of looking past that headline fear to see the strategic intent behind it.
It's about understanding the business model. Amazon looked terrible on paper for years if you only looked at profit, but if you looked at market share, it was a monster. SMCI is just prioritizing dominance over short-term profit.
And for anyone listening who feels like they missed the boat on NVIDIA or AMD, this seems like a different way to play the same theme.
It's the classic picks and shovels play. You don't have to bet on which AI model will win. They all need servers. They all need liquid cooling. SMCI is selling the shovels to everyone.
Or in this case, the liquid-cooled modular high-tech excavators.
A much better analogy, yes.
Before we wrap up, I want to leave everyone with a final thought that just occurred to me while we were talking about this.
Go ahead.
We're all amazed by this 123% growth number for SMCI. But think about what that physically represents. SMCI builds the racks, the plumbing, the actual metal and wires.
The hardware.
If the company that builds the literal physical infrastructure is growing at 123%, what does that tell us about the sheer physical scale of the data centers being built right now?
That is a profound question.
I mean, we talk about AI in the cloud like it's this ethereal thing.
Okay.
But this proves it's heavy, it's hot, and it requires this massive industrial scaling. If the plumbing is growing this fast, is it possible the market is actually underestimating the size of the entire AI building project?
If SMCI's order book is any indication, you could argue the physical build-out is accelerating faster than anyone predicted. We might just be in the first inning.
Which means the sleeping giant might not just be SMCI, it might be the entire sector.
A fascinating possibility.
Well, that is all the time we have for today. A huge thank you to the analysts behind this report for the incredible data. As always, we encourage you to check out the analysis report for yourself.
Always do your own research.
Absolutely. Thanks for listening.
Don't forget to like, share, and subscribe for more.